Been a wild week in the markets. The Dow hit another record close Wednesday, almost hitting the 27,000 mark. Then yesterday we started to see a major sell-off. And again, this morning we started in the green. But look at what's been going on pretty much all day so far. The Dow's off about 295 points. That's a little more than 1%. Let's take a look at what is going on. First of all, interest rates. This is what you have to think about. Interest rates in the United States are continuing to rise. The 10-year Treasury, which is a very influential bond, is at 3.23%. This is the highest it's been in years. Now, this is because of news that the economy is steadily growing and new jobs are being created. When an economy starts to feel a little hotter, you start to see interest rates go up. We also got the new jobs numbers this morning from the Labor Department, and indeed, in September, the unemployment rate dropped to 3.7%. That's a number that we haven't seen in nearly 50 years. But anybody who's been following me for the last quarter century knows that I say, please don't pay attention to this number. This is not the most important number. This is actually the most important number, the number of jobs added. 134,000. It's not bad, but it's not anywhere close to what we've been doing in previous months. And hourly wages, this is not bad, rose 2.8%. That's over the last 12 months. So the average hourly wage is 2.8% higher than it was a year ago. Still, these are all generally good indicators for economic growth, which ironically is what is pushing the sell-off that we are seeing now on Wall Street. Let me show you the sectors that saw the most new jobs last month. Healthcare, which has just been a consistent grower for years, even through the recession. 26,000 new positions. That, by the way, doesn't all mean high-paid doctors or nurses. It could mean home health care aides. So don't read too much into it, but it's a good area for job growth. Transportation and warehousing up 24,000. Construction jobs up 23,000. And manufacturing jobs increased by 18,000. President Trump has taken credit for declining unemployment and a booming economy, and he deserves some of that credit where credit is due. But I always like to remind the president, this is when he became president. This is since the end of the recession. This is 2009. March 2009 is when the recession, when the stock market bottomed, and I like to think of that as sort of the end of the recession. That's been the unemployment rate. Okay? And in fact, if you see, it's almost flattened out a little bit under Trump. So you make what you want of it. I sometimes think presidents take too much credit and get too much blame for unemployment. When Donald Trump tells you that he has changed the employment picture in America, I just need you to understand. I'm going to block it off here so you can see the Donald Trump part. That's the Donald Trump part on my left. Everything behind me is the Barack Obama part. All right. In truth, America's current economic expansion is 9 years in the making. That well precedes the president. Let's bring in John Harwood from CNBC. He's the editor-at-large. He joins me now. It's a tiresome conversation, John, so I don't want to belabor it all that much. I'm not blaming the president. He's continued things that are going on a nice tear. But let's get back to the stock market. Why are interest rates rising, and why does that spook the markets? I mean, 3.23 on for a yield for the 10-year. It's not actually historically all that high. It's just the highest it's been in many years.
Well, the Fed has embarked on a campaign of raising interest rates. Jay Powell has said we're still not at a neutral position. In other words, monetary policy is still easy. He plans to raise rates more. And the danger is that the economy overheats and everything then we flip into a recession and people are, the current expansion finally runs out of gas. It's not that surprising that the jobs number is lower on a monthly average under Trump than it was at the end of Obama because, as you said, it's a 9-year expansion. That's very long. And at some point it's going to end. And this is where the skill of the Federal Reserve comes in over how exactly they manage the return to steady state monetary policy.
So listen, if interest rates are going up, if the Fed chair says we're not there yet and rates are going to go up, it's human nature, right? When stocks are the only game in town, when you can't get 1% with your money in the bank, you're going to play the stock market. It's a little bit riskier. When you can go to a bank and get 2% or 2.5% or 3% or 4%, it goes up like that, there are going to be people, regular investors and professional investors, who are just going to start to take their money out of the market. So what do investors think about this? Do they say, all right, time for me to start paring down some of my investments? Or is this just a reaction to a very quick increase in interest rates?
Well, I do think over time there's going to be more of an inclination to move money in the way that you suggested because everybody seems to agree this is a pretty highly valued stock market right now. And so you've got to wonder, if you're in stocks now, am I really in the best position? Or given the fact that interest rates are going up, is it a safer thing for me to move money into fixed income assets? And I think that's driving some of this decision making.
Hey, MSNBC fans, thanks for checking out our YouTube channel. Subscribe by clicking on that button down there and click on any of the videos here to watch the latest interviews and highlights. You can get more MSNBC for free every day with our newsletters. Just visit msnbc.com/newsletters to sign up now.